All right, I'm going to call up now the moderator for this panel, Hannah McQueen, founder and director of Enable Me NZ, established after dinner speaker herself and business speaker, TV presenter. She's going to run this panel, if you wouldn't mind coming up. And we've also got Richard Griffiths and Scott Figgenshow to join her as well. You're on.
Okay, we had some pretty compelling evidence, I guess, of us wanting to think big with regards to changing our housing system, our housing market. I think we all agree, we can see the benefits, we can even see some of the financial benefits. But whenever you want to think big, you have to be brutally honest about your starting point and the constraints of your starting point, otherwise it's hard to work on the how. We get the why, but how? And one of the things that underpins our housing market is the finance industry. If we have strong banks, the housing market is doing well. When they get a little bit skittish, or when Australia gets a little bit skittish and sucks all the money out of our banks, that is a problem for us. So we've got two expert presenters who specialise in the financing. One is going to be talking about green mortgages. I don't even know what that means. It sounds kind of sexy with regards to finance, I guess. We're going to have green mortgages, and we're also going to talk about how you can come together and create some shared ownership, shared equity arrangements for people coming into New Zealand, or the Kiwis who are living here trying to get onto the housing market. One thing also that probably needs to be called out, if you're going to be increasing the cost of anything, and when you want change, it comes at a cost, we possibly need to be running an inquiry into why we've got some of the highest building costs already in this country if we're going to be introducing more legitimate building costs. Because it doesn't always work from a business perspective, and our economy is a business, to simply just heap more costs on. We've got to work out what levers we can pull to make savings somewhere else. So we've got some speakers here who are going to introduce themselves and explain why they're the expert in their field, and then they're going to present hopefully some really exciting data which I'm going to concentrate on. I read that economic report last night. Oh my gosh, had to concentrate on that one. But we want some nuggets of inspiration, please, people, and then we're going to take some questions and get the show on the road. Thank you.
Thank you very much. By way of introduction, my name's Rich and I'm a green mortgageaholic. It's really great to have an opportunity to speak about something that I'm so passionate about. It doesn't have a great deal actually to do with my current day job. It's more of a legacy from days gone by. There you go. So, Hannah, you said you weren't sure what a green mortgage is. A green mortgage is, this is my own definition, any mortgage product which gives an advantage to the home buyer for buying a sustainable home. Why do green mortgages matter? If you can attach a green mortgage and potentially make it easier to buy a home due to the preferential finance you're given for it being sustainable, ultimately the idea is that leads through to higher house prices or higher values for those properties. Higher values means that more of those homes might be built, and then obviously you have the overall outcome that sustainable outcomes are improved and we tackle climate change. What's behind the idea for that? There was some work done in the US looking at mortgage default rates associated with sustainable homes, and they found that there was nearly a third lower default rates associated with sustainable homes compared to their unsustainable or less sustainable peers. The reasons for that are pretty obvious. If you've got lower bills, that gives you more money to play with in the home. You have more money that you can use to repay your mortgage, and that means that in times of mortgage stress, you're less likely to default. But there are other reasons why banks care about this kind of thing. First of all, there's been a lot of discussion recently about the role of green mortgages in being a source of green bond finance for banks, and that gives them a useful way to raise money on international markets. There's obviously a CSR benefit for any bank that looks like it's doing or offering products that are environmentally preferable. And actually, probably the strongest driver, if you speak to the banks themselves, the idea of offering mortgages to households that care about this kind of stuff. The people in this room and the people that care about green mortgages are also likely to be the kind of people that have good professional jobs and are very low lending risk anyway. So there's all sorts of reasons why banks should care about this kind of stuff. In terms of types of green mortgage, there are a few. So the most obvious is that you get a lower mortgage rate in return for having a more sustainable home. Others offer a higher loan to value, so you can be lent more money on a sustainable home. Others, you can get a mortgage advance, so you have a normal mortgage, but you might be offered an additional amount to borrow on top of your main mortgage, either at the same or a discounted rate in order to do sustainable things and upgrade that home. And then the last and probably least useful version is just where you get given some money back for doing sustainable things. You might get cash back of a few hundred or a few $1,000s in return for doing long-lasting or making long-lasting changes. My interest came from my work at the UK Green Building Council a few years ago, where we looked at the role of assessing mortgage lending by using EPCs, which are energy performance certificates, to work out what you could lend to a home. And it turned out if you add EPC ratings into the calculation of mortgages and energy expenditure, you can much more closely model what the energy bills of that home might be, and therefore what the discretionary expenditure of that household might be. And therefore it really does make sense from a banking perspective to use EPCs in their affordability calculations. That spawned a much bigger study by a range of organisations in the UK, including the UK Green Building Council and the BRE, but a bunch of banks as well, including Nationwide, the UK's biggest lender. And following on from that, I don't know if any of you saw on LinkedIn, but last week across Europe, 37 banks came together to launch a green mortgage pilot, which accounts for some extraordinary percentage that passes me by now of the European mortgage market. So this is gaining huge traction over the other side of the world. Wales, a much less noteworthy example normally, have come out and put in a scheme recently which is quite interesting. There's a help to buy scheme there which is government backed, and they're offering more money for homes that are of a higher sustainability and energy efficiency standard. And there are some kind of current industry examples that are growing as well. So we have National Australia Bank in Australia have recently raised money on the international markets for a green mortgage-backed green bond. And in the UK, Barclays, which is one of the biggest home lenders, has recently launched its first green mortgage product. And for context, the only previously available one was with the Ecology Building Society, who are absolutely tiny. So for a bank like Barclays to be doing the same thing is pretty game-changing in the UK context. There are some examples. I should stress that despite my British accent, I am now a resident of Australia, so I do have an interest over there. Westpac and Bank Australia and Bendigo Bank have all historically offered green mortgage products, and Bendigo still do, although I don't think it's very well taken up at present. And here in New Zealand, Kiwi Bank, I'm told, do have a green mortgage product. Again, I don't know how well that flies off the shelves, but they offer a mortgage advance and actually give some money back to the homeowner to offset the cost of that if they do certain long-lasting and warranty-backed measures on their home. One of the things I wanted to talk about here, which I think is a very exciting thing and why I'm talking about this a lot at the moment, is that there is a different way to do green mortgages. Historically, it's been about trying to have a product on the street that anyone could march in and say, I'm buying a green home, I want a preferential mortgage rate or your green mortgage deal. The Romanian model is slightly different in that it's an agreement between the bank and the developer, and brokered by perhaps the green building councils in a given country. They can then say, we're going to build 1,000 homes that reach this standard. Will you, the bank, offer a discount against those homes? The bank agrees, and then from that point onwards, the developer can go out to everyone that enters into their market and say, well, if you come and buy one of our homes, we can offer you 0.5% off your mortgage rate, which cuts down enormously on the awareness and the transaction costs associated with green mortgages, and that is something that's held back the market quite considerably in the past. And that's what's happened in Romania. They were the guys that came up with the idea. It seems bleedingly obvious, but they've actually been quite successful, and I'm very keen actually to see the numbers behind what they've achieved, and there are a few others. The Barclays scheme I mentioned just now is following that same model. Just very quickly, a few of the potential barriers. In the absence of a mandatory disclosure scheme, it can be a little tricky. In the UK and in Europe, you have EPCs on which to base green mortgages, so you can say, we'll offer a green mortgage to anything that's rated A and B. Here, I understand you don't have something like that, and certainly in Australia, there isn't currently something particularly appropriate for that. Again, in Australia, and I imagine it's probably relatively similar here, you have a very low rate of mortgage default, so the argument for reducing default risk becomes at the moment relatively trickier to make. And it's also a very competitive mortgage market at the moment. We have unprecedented world low interest rates, and trying to shave off 0.5% when your rates are already only a few percent anyway is currently relatively tricky. Not impossible, but trickier. The opportunities you have here obviously are a relatively more climate change friendly government compared to many of the others across the world and historically here. You also have rising energy prices, and again, that's a phenomenon across the world, and so it becomes relatively easier to show that there's a benefit in terms of household costs for having a green mortgage deal. And then finally, I read while researching for this presentation that there is actually, despite historically low mortgage default rates, quite a lot of concern at the moment about future mortgage stress if rates were to increase in the future. So there is the potential to mitigate some of that by trying to get people to buy more efficient, lower cost homes. So the mortgage of the future, I'm trying to pander to Andrew somewhat here by showing my example. So you can imagine a future where somebody walks into a development, maybe having the opportunity to buy a few different homes, and they have the opportunity to perhaps buy a slightly more expensive Homestar rated home that they know that they're going to face lower overall mortgage costs for. And the net effect of that, given the energy bills and the mortgage costs, that means that more expensive, higher spec sustainable home becomes a much more attractive proposition. So hopefully, with some open-minded finances in the room, that might be where we end up in a few years' time. Thank you.
Thank you. Come and take a seat. Okay, we've got Scott up next, who's going to be talking about shared equity and different ownership models. Thank you.
Great, thanks.
Thanks, Rich. That's great.
Just going to switch there. There we go. Good morning, everyone. Still morning event. I'm Scott Figgenshow, Chief Executive at Community Housing Aotearoa, and it's great to see a few friends in the room here, and many folks who we haven't necessarily engaged with so far. And Andrew, thank you for organizing today. I wanted to just touch briefly on one of the aspects that Shamobile talked about here, and that yes, we should be embracing Homestar 9, Homestar 10 for all of our social and affordable housing in New Zealand. And that would be pretty easy to do in the progressive home ownership space. What I'm going to talk to you a bit about today is what the community housing sector has been doing, quite frankly, for over 20 years. And we see an opportunity with the KiwiBuild announcements for how we can dovetail to help make sure that KiwiBuild can make a $600,000 house actually work for somebody earning $60,000 or $70,000 a year. So the programs that have been running for the last several years, delivered by Dwell Housing Trust in Wellington, Habitat for Humanity across New Zealand, the New Zealand Housing Foundation here in Auckland and in Christchurch, Marlborough Sustainable Housing Trust in the Marlborough region, and then Queenstown Lakes Community Housing Trust in their region, have all been working on a similar set of approaches. And there are over 790 homes that we currently track. As the peak body for the community housing sector, we track a fair bit of data on what providers across the sector are delivering. And we're proud to say there's been over 1,000 units of various rent-to-buy and shared ownership programs going back to 1995, and we're currently tracking 780 of those. So we're saying, you know what, folks? We've done the pilot. It's ready. It's time to put some legs on it. Let's just talk a little bit about kind of who we're serving here. So many of you will be familiar with the housing affordability continuum. So it's definitely the intermediate market. So these are the can rent but can't buy folks that are working. There are working families. Many of them might have previously been in a situation where they might have had social housing, but then doing better, trying to make that next step out. but the private market is not the place that they can enter into without some form of assistance. So let's talk about what that looks like. As we're mentioning, there are two broad types of programs. So I'll quickly say how they work before I go into kind of why some aspects of the financing are so critical. Rent to buy is essentially for households who have not been able to save a deposit and can't even put one together in the immediate term. Now, again, there'll be working folks. They may be on minimum wage incomes, may have one or more incomes in that household, but they may be even struggling with affordability in the rental market. But they definitely, for reasons of security of tenure and for reasons related to wanting to have absolute ownership and control of where they live, an ownership product is definitely the right option for them. Shared ownership is really where folks have been able to save a deposit, but in today's markets, and there are many different markets we've got to remember we've got across New Zealand, they can only afford, say, 60% or maybe 70% of that house. So this is a way that a $600,000 house can be affordable to someone who can come up with a mortgage and deposit for a $450,000 house. Now, this next part, so if we accept that those are the kind of two basic programs in there, how are we going to finance it? Now, the next bit I'm going to go through here, we in the community housing sector thought that this stuff was pretty much well understood by everyone, but we found that that is not the case. So if we want to back the truck up a little bit, let's all try to get an understanding of what it's going to take if we're going to significantly deliver more pathways to home ownership for Kiwis. The first piece is around uplift, the second piece is around value capture, the third piece is around retention, and the fourth piece is around recycling. Let's take these one by one. In the uplift space, when community housing providers act as one of the development partners, they're able to participate actively in the value uplift that occurs when we turn one house into four, or when programs like inclusion rezoning confirm the agreed percentage of new homes that are to be developed as genuinely affordable in a marketplace. And I also want to just make sure we're all on the same page that genuinely affordable is when the household is spending roughly a third of their income in rent or mortgage. So it isn't based on a price point, it's based on what's actually affordable for the household. And by the way, the inclusion rezoning aspect has been working in the Queenstown Lakes District now and has generated tens of millions of value that has come into a trust structure that's been matched by some other public investment that's made that work. Capture. So if we've done that uplift and we've figured out how we're going to make some percentage of the new homes affordable, we've got to make sure that we capture and hold on to that value that's there, as opposed to trying to always market to a market price. And we were able to do that when we turned those land into housing. And one of the benefits that the community housing sector is able to offer that is that we are a regulated sector, and we do that public reporting through both Charities Act as well as through the Community Housing Regulatory Authority that's run by MB. In the retention side, as the development turns into homes, the involved development partners, including both the private sector entities and the not-for-profit community housing provider, the trust is used to hold on to those shares in progressive home ownership. And as families are able to buy out more of that share, they're able to do that, and it returns that value back into that trust. That's how we retain that value. So that investment that went in once, we're able to hold on to it, and then what we do next with it is we recycle it. So when a family has decided to move from owning 60% of the home in a shared ownership case to the point when they're owning 100% of the home, that value that's come back into the trust, we can redeploy as part of the equity to build the next house. This is, for us, part of the key economic shift that we need to make if we're going to be able to balance what will always be constrained public finances and what will always be constrained household incomes if we're going to actually make this a permanent setting in New Zealand. So this is the shameful plea for the community housing sector here to show that the developments that we've been doing for quite a long period of time have been doing this and been doing this quite successfully. So there is absolutely a proven track record. There is absolutely an ability to work at scale. There's absolutely the ability to grow and lead in this space. And I'm going to pause on that one for just a moment, simply because The opportunity that's in front of all of us right now with the current fantastic work that MB is doing, as well as what our ministers are setting. Minister Celeste this morning talked about partnership, didn't she? How we make that partnership work means that we cannot afford to have them start up a new government program in this space. There is a track record of delivery around partnership between private sector, not-for-profit developers and providers, and government. That means we need government to fill some very specific roles other than being a provider. Part of that is getting really clear that we are doing this in a not-for-profit tax-exempt way, and that's one of those key policy settings we need to get embedded. And I think the last part is that we have a robust set of legal structures working around the country. We have here in Auckland the Waimahia Inlet development, many of you will be familiar with. Not only is that Auckland's first special housing area, it was the first to actually deliver a significant portion as genuinely affordable homes. And my understanding is that that was also one of the early developments that embraced both off-site construction technologies at scale, as well as set the internal targets around meeting, when it started then, Homestar 6. Now, that's a whole package that needs to work together, and I'm thrilled to see that we have on the table today talking about those higher performance standards that should be embedded in there. It means about partnerships that play to everyone's strengths, and it means that this is a safe, secure place for public investment. So look, as part of a finance discussion, we've often gone to a lot of the detail. Today, we didn't want to do that. What we're finding is these 4 aspects around how we manage value in developments we're proposing is the part of this narrative that we all need to get our heads around. And to our friends in the media, Corin, this is an area we'd love to see yourselves delve into and see where the public sits on this. But we think this is a key aspect, one of the switches we can flick. We know it works. We're here to help you do it. And with that, I'll stop for now. Thank you very much.
Thank you. You can stay there for a second, Scott, because I've got a question for you.
Sure.
We're going to take some questions, and I'm going to try and understand social housing a little bit more by asking you a question, Scott, so I can understand this. And I apologise, I'm an accountant, so I'm a numbers kind of gal. If a family can afford, based on their income, a mortgage of $300,000, and the house that you're building or creating is going to cost $600,000, just walk me through how that works, because they can afford 50% of it, and so they're paying rent or mortgage, or how does that work? Sure.
So in the shared ownership approach, the family would be buying, say, a 50, 60% share of that house. Mm-hmm. They have responsibility for all the outgoings. There is a well-established property sharing agreement that uses the tenants in common form of legal contract, and that other share that the family didn't purchase is held in trust, held by the community housing provider. They are not paying rent or any servicing on that aspect. The family is, however, paying all of the rates, maintenance, outgoing on the property. And we've always felt that was a fair exchange for having both the full occupancy right to the house, but not necessarily getting the share of the uplift that comes from that. So they are owning, say, 60% of the house. So when time comes to sell, market price is whatever it is, they'll realize 60% of that, not 100% of it. And so this is one of the areas we all need to get some comfort with, that nobody has made a windfall gain disproportionate to their share of interest in the property. And so we've always said that's a fair proposition, and one that will help us deliver both genuine affordability as well as protection of the public investment.
And so then that money gets paid back into the trust, so that's how they get their return on their investment. They've made this capital gain, even if it's a not-for-profit, right? And so then when you say recycle the property, it's recycle the funds, right? Not necessarily that property, because that person would have the right to sell to someone in the market to get those market rates. Is that what you mean?
Correct. The trust will always kind of retain that right of first refusal. So if that's still a high need area, and the trust wants to offer the home to a new family when the first family says, yep, we are shifting to a new job in Christchurch, we want to sell, yep, new family wants to come in, they only have to come up with their 60% share. We still have the other part that's already been paid for. We don't have to pay for it a second time. That's awesome. So that's the key key recycling bit
That's
there.
great. And there's just one question up there for you, Scott. When you talk scale, how many affordable dwellings are you referring to, and what other infrastructure, for example, parks,
Yep.
community buildings, are included as part of that future landscape?
So the slide that's up there right now is I think it was last Saturday's opening at Waimea Inlet of the new playground. So that development, again, was led by a consortium of community housing providers with Mana Whenua, a direct engagement and ownership. And that development of 280 homes was basically delivered on time with a mix of social, affordable, genuine affordable, and market homes. So if we're going to scale this up, we should be having 10 or 15 200 to 300 unit developments going at any given time, shouldn't we? Kiwi Build is part of that opportunity. But what we need to make sure we get right with Kiwi Build is some of these settings that are making sure we're delivering genuine affordability. And we know that Kiwi Build has said they need to recycle their $2 billion of public investment. They need to recycle that arguably many times over the 10-year period. This is one of the ways. Not only can we recycle it, but we can make sure we're delivering genuine affordability at the same time.
Thank you. That's great. There's lots of questions, but you might have to ask them directly because the screen is like yelling at us that we're over time. So thank you very much. Thank you.